Hi guys, welcome back to the channel. My name is Dave, and today I want to talk about QYLD. This is a NASDAQ 100 covered call ETF from Global X. Now, this is a controversial one, I'll be honest. Some people love this. It's an income ETF. It's not a growth ETF. So the people that like growth, that are looking at total market return, this isn't for them. Especially if you're 25 and you want to grow your wealth, ignore this thing. But if you're older and you want to add some of this to your portfolio, is it okay? Sure. If you have a good use case, I would say. So that's what we hope to answer today, because when I trade options, because what this is QQQ and a dress. And that dress is a covered call sold at the money out about 30 days. And that's how it generates a bunch of premium, right? Kind of clumsy. Now, when I sell options, I like to think of myself as elegant, refined. Like 007, a secret agent. Like I dive roll in and then I collect my premium and I stand up and I say something witty and then I dive roll out. And then I take my wife out for a sushi dinner because that's the kind of guy I am. But not QYLD. QYLD is more of, like Wreck-It Ralph with a sledgehammer. And he's going in the china shop, right? And he's swinging for the fences like Frank Thomas style, trying to hit home runs every time. And, every now and then he's screaming out like Rocky, premium, right? It's not elegant. It's not refined. But doesn't mean it's not effective. It might be right for some people. So today I hope to answer that question. I hope to answer, how does this thing work? How does it generate income? How are the taxes handled? What is a good use case? So if I can do all that, I'll be really happy. So if that is what you're looking for, please stick around. So QYLD is first and foremost an income ETF. If you want growth, go for QQQ. If you want income every single month, QYLD might be a decent option. So they've been distributing money every month for 8 years running. QYLD does this by writing covered calls, selling covered calls. We'll talk about what all this means. It's been around since 2013. The expense ratio is about 0.6%, so expensive, but not outrageous. You got about $6.5 billion in net assets. So what everybody loves, if you down here to the right, is the distribution frequency. Every single month, they're putting out about 1%, 11.81% distribution yield. So that's their objective, and they do this by writing covered calls against the NASDAQ 100. And if we look at what's actually in QYLD, you're going to find the NASDAQ 100, just like QQQ, by the way. Apple, Microsoft, Amazon, Tesla, all about the same weights as QQQ. The difference is, if we go to the very bottom of this, you're going to see that covered call they're selling. In this case, full coverage here, right? Every bit of collateral that they have. 4,767 contracts that they've sold, each one valued at over $46,000. So when they do this, they get to make that phone call and say, send me my premium of $222 million in change, right? It's got a 3/18 expiration, and the strike price is $14,075, right about where it's trading right now. So that's the .NDX index. So that's what they're actually doing. And if you take 14,075 times 4,767 contracts times 100 shares each, you're going to find that's about $6.7 billion. Yikes, we're talking about big numbers here, folks. Let's take a quick look at the charts. If you jump in here, this is a 5-year chart. It's not very impressive. It should move sideways. It's not going to really be growing. That's not their idea. It's not growth. It's about putting money in your pocket every single month. So that's the 5-year chart. Kind of ugly, especially over the last couple months. It's dropped considerably, just like QQQ. Now, if we go to the next slide here, you're going to see a comparison. Now, this does not feed back distributions back in. So this is the flat line. You're going to see over the last 2 years, there's the performance on the bottom of QYLD. On the top, QQQ. So you can see how much it's outperformed. Now, if you add back in all those distributions, it would come a little bit closer. But if you are investing for growth, QQQ is your answer. It's not going to be QYLD. And this explains their covered call option component. It's very robotic. They do the same thing every single month. They sell their covered call, they collect their premium, then at the end of the month, they close out that position and roll it out to a new position. Again, out about 30 days at the money. Repeat, 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 like a robot. So I wanted to do a side-by-side comparison of QQQ and QYLD because you're going to see they're exactly the same, almost exactly the same. The only difference is there's that call option that you throw in there to QYLD. So QYLD is essentially QQQ with a cute little sundress on. That's it. There's no difference. So how do they behave? Well, if we go to Fidelity and we punch in that we want to do one of these NDX options, you can see what it looks like here. Now, to actually trade this, you'd have to call Fidelity and work some things out. But for you and I, just to kind of do as a comparison, we can look at this right now and say, okay, this is $14,035 each. If I wanted to buy 100 shares, it cost me $1.4 million. And for that, once I buy it and sell to open, one call, April 4th, out about a month from now, I would collect $50,000. Okay, that's my premium that I put in my pocket right now. It's the same exact thing that they're doing. So if I take that $50,000 and I divide it by $1.4 million, I get a number of about 3.4, 3.5. Okay, that's my monthly return that I would get from this investment. Now, if I multiply that times 12, I get about 40%. So just to show you that this is the same thing as QQQ, if we go over to the next slide here, we're going to see that QQQ right now is trading about $342 a share. If I sell to open one call contract out about a month at about the at-the-money strike price of $343, I would collect $1,165 in premium that I could put in my pocket right now. If I take that number and I divide it by the $34,226 that I have to buy 100 shares of QQQ, I get that 3.4% number again, just like the NDX index option. So QQQ, if you wanted to emulate QYLD, this is how you do it. You'd buy 100 shares of QQQ. You would sell at the money calls out about a month. You get the same kind of return. As IV moves around, it might change a little bit, but in general, right now with the crazy market that we're in, it's about 3.4%. Does that all make sense? We'll talk through it now more, but that's the strategy and that's how it works, and that's how they're generating this premium. So if we do a comparison of these two, which is pretty much the same thing, but one has an at-the-money sold covered call out 30 days from expiration, we can see that there are benefits to both, depending on how it's happening in the market. Now, this first one we're going to look at is when the ETF goes up in value. So if QQQ rises 5%, obviously QQQ makes 5% more. It's worth 5% more. But if QYLD goes up 5%, you're actually punished for it. There's no benefit to the price going up, right? You lose in that sense because of the way this thing is structured, how this robot works. So for the robot here, remember, you collected 3.4% in a premium. When you sold this covered call, you get to put that in your pocket. But then the stock price goes up and then it expires. The day before it expires, they settle this thing in cash. So since it went up in value, they got to close this out and it's going to cost more to close it. It's going to be that 5% of intrinsic value that's now built into that option. So you're going to have to pay to settle that, and it's going to cost them about 5%. And just to prove out how this math works with QYLD selling at the money call options, you're limited to just the premium that you're collecting. So if we pull up this original QQQ option that we were talking about selling at the money at $343, we see that we made $1,165. We put that in our pocket. That's our premium. So let's work through those numbers. We made 3.4% selling at the money call option, $1,165. But now as this QQQ climbs, and in our example, we're going to use 5%. That means the stock price goes from $343 up to $360. So if we take this and we say 360 minus 343 times those 100 shares, our cost to close, that intrinsic built-in value, is $1,700. That's how much it costs us to close it. So we made $1,165, but we lost $1,700. So overall on the option side, we lost $535. It's a loss. But on the stock side, we make it back. So we initially bought 100 shares at $343. Now it's worth $360. So if you do the math there, you realize that your $36,000 that you have now minus the $34,300 you initially invested means you made $1,700 on the stock price going up, because QYLD won't allow this to get called away. They're going to close it out. So they made $1,700 on the stock going up, but they lost $535 on the premium, right? Or on the loss to the option. So overall, they kept their premium of $1,165, but it's capped at that. It's capped at that 3.4%. Whereas for QQQ, if you just own that alone and it goes up 5%, 10%, 15%, 20%, wow, it can do quite a lot going to the upside, whereas you're capped and limited with QYLD and that option scenario. Now, it's different for me as an investor, because if I did this, if I bought QQQ and it went up 20%, let's say, I would just keep my premium and let it get assigned, get called away. But they can't do that with QYLD because that's part of the robotic program that they have to follow. So if it goes up 20%, they're really going to get punished in this situation. So it's something to consider when the market is going up and to the right. So the next scenario is when the ETF is just flat for the month, right? And it can move around some, but at the end of the month, when they close this thing out, if it hasn't moved at all, like if it's just flat, like Putin's heart, right? Doesn't move at all. Well, then QQQ makes nothing, right? You bought it for 100 and it's still at 100. You didn't make anything. But for QYLD, this is the perfect scenario, right? Because the option expires and they make that 3.4%, which was that $222 million? Not too bad. That's the best case scenario for QYLD. That's really what you want to hope happens. But of course, if this happens month after month, IV is going to change and you're probably not going to get quite 3.4%. But in this case, that's the ultimate for QYLD. And the last scenario is that the ETF goes down. And this is where we see the downside protection of QYLD. So in this example, let's say at the end of the month, QQQ has dropped 2%. Well, obviously you've lost 2% in QQQ, but with QYLD, which is the same exact thing in address, well, the option expires. They get to keep the 3.4%, but they lose 2% to the downside, so they essentially made 1.4%. And that's where they get the protection of this covered call strategy. And you will see that reflected in the price at times. But with everything going on in the market, it's not always apparent. But that's where you're going to see it, and that's an example of how that works. All right, so let's move on. Let's talk a little bit about use cases. Like, is there a point where you should be adding something like this to your portfolio? And I can think of a couple. One, you don't want to mess with options, right? And you don't want to buy one SPY option and pay $42,000 to buy the 100 shares so you can sell the covered call. So you just buy a $20 share of QYLD and get your 1%. I could see a use case like that. But one that always comes to mind, and I've been talking about a lot on this channel, is paying off your mortgage. Or maybe just paying your cable bill or your electric bill, right? And you can put some money into QYLD and use that and fund that, right? Maybe that works for you. Maybe that covers what you want to do. It doesn't always have to be about total market return. Sometimes it's about taking care of business at home. So one use case that I would always talk about is this covering your mortgage. So if you have a $100,000 mortgage right now versus, and we're going to say pay off the mortgage or invest in QYLD, well, a $100,000 mortgage with a 15-year at 3%, which I know it's gone up a little bit, but a lot of us locked it in right a year ago under 3%. So I use 3%. $100,000, $691 a month. And if you take that out to 30 years, it's only $422 a month. But if you invested that in QYLD right now, right around $20 a share, you get about $12,000 per year estimated, right? Or about $1,000 a month. And after tax, depending on your tax situation, it could be about $550 to $750 after tax. Now, there is obviously risk with QYLD, but I know for me, being a little bit of a gambler, I would probably do this over paying off my mortgage. Now, everybody's different, so don't do it because Dave said so. Do it because it makes sense to you and you work through the numbers. But for me, I'd be willing to take this risk on, put into QYLD, have it pay my monthly mortgage every single month, and maybe leave a little bit of extra money in my pocket depending on my tax situation. And with all that said, wow, I'm looking pretty good because at the very end of this, I have my house paid off, and I still probably have a pretty decent basis in QYLD that I can sell off. So I'm way ahead of the curve in this situation. So now let's jump into taxes real quick and talk about how this thing works. They've got it broken down, as you can see here, and you can find all this on their website, but there's been a lot of controversy over the last year because a lot of these types of statements were being reported as return of capital, ROC. And basically that means that you put $1,000 in and they start giving you some of your money back, right? It's a return of capital, a reduction to your basis where they're giving you your basis back. So you don't pay any tax on that. So people are really excited about that. But that's not how this fund is supposed to perform, right? And it should come back as net investment income and some realized gains if everything's performing properly. So they were caught off guard though, because I pay quarterly taxes, and if I was expecting ROC, because I saw that, it would really annoy me as well. But they do have a disclaimer down here at the bottom. So apparently we should take that to heart. So if you get into this one, I would claim everything is ordinary income until you find out at the end of the year. So you can pay your taxes as they're due and stay up on top of things. So just a note about taxes, but this one can get kind of complicated. Now, having said that, a return of capital for somebody maybe late in life that hasn't quite retired yet might be a very exciting idea because it's all tax-free. And then when you do retire, you're paying at a lower tax bracket. You'll start taking this money out. That might work out quite well. But in general, I would treat it as ordinary income whenever you get these distributions. So my opinion on QYLD, if you don't want to manage your own options and you want to use something like this and you have a good use case, have at it. Add it to your portfolio if it makes sense. But if you're not so sure, and you still want some of that income, maybe you take a couple $1,000s. Maybe you put half of it in QQQ and half of it in QYLD. That way you get to have the upside potential of QQQ. You also get that QYLD income. It would still be 6%, which is pretty darn good. Make a little soup out of it, right? There are lots of alternatives. You can make a huge soup out of all this, right? So even from Global X, they have a whole big lineup. So RYLD is one that's just like QYLD, but it celebrates it on the Russell 2000. There's QRMI, which is a newer one. That's QYLD with a protective put added. So it protects your downside a little bit. Then there's NUSI, another example. That's QYLD, but instead they sell out of the money by about 3% instead of at the money with a protective put. So it gives you a little bit of upside. And then there's JEPI. This is one that I bought about a year ago myself. It's actively managed by some smart folks over at JP Morgan. I like that they had the name behind it of JP Morgan. They do calls and ELNs, equity linked notes. Those are a lot of fun. Go do some research, report back. Let me know what those are. I've done a little research myself. But if you have any questions on any of these or you want to say video on any of them, just ask me to do those as well. I'd be happy to give you my opinion. We can work through them, come up with our own gigantic soup. Bottom line, QYLD is an interesting one, but it's not for everyone. You know, if you're 25 and you want growth and you want to get wealthy, don't buy QYLD. It's QQQ or a host of other ETFs that would be a better option that are going to give you a better overall return. But if you're 60, you've got a giant pot of money, and you want to put some to work and strip some of that income off every single month, well, QYLD might be good for you. It just depends on your personal situation. So at least that's my opinion. So if you have any questions on any of this, please ask down below. I really appreciate you watching. If you like this type of content, please like and subscribe. We'll see you next time. Have a great night. Take care.